All right, let's get right into it. Today, we're going to pull back the curtain and show you how the big institutions, the big money, really see the market. The whole point here is to help you stop chasing all those random, confusing candles and start tracking where the actual money is going. This, my friends, is the institutional edge.
So let me ask you something, and I bet this will sound familiar. Have you ever done all your homework, you've lined everything up, you find what looks like the absolute perfect trade entry, you hit that buy button, and bam, the market just instantly, and I mean violently, reverses right in your face. It's gotta be one of the most maddening things in trading, right? Makes you want to throw your computer out the window. Well, take a look at this. This right here is exactly why that happens. And I'm telling you, it's not bad luck. It is by design. What's happening is you're trading right into something called an institutional liquidity zone. Basically, your perfect entry is the exact spot where a big bank or fund needs a flood of orders to fill their own massive position. You become their liquidity. And that is the essence of the retail trap. Okay, so if we're going to stop being their liquidity, we need to start using their map. And that brings us to the heart of this whole strategy, the institutional compass. This is the tool they use to figure out where to build their positions and, frankly, to control where the market's going. It's called the volume-weighted average price, or as you'll hear me say a lot, VWAP. So what the heck is it? Well, put really simply, VWAP is the true average price of a stock for the day. But, and this is the important part, it has a crucial twist. It's weighted by volume. So it doesn't just care about the price, it cares about where the heavy money, the big orders are actually trading. It's literally tracking the money. Now check out the difference here, it's pretty stark. On the left, you've got your standard moving average. It's okay, but it only looks at price and time. It's always looking in the rear of your mirror. But look at VWAP on the right. See how it's balancing price, time, and that critical third piece, volume? This changes everything. It's no longer just a line. It's a measure of the true fair value for the day's biggest players. And this is where it gets really practical. Look at how it works. When the price is trading above that VWAP line, it's a clear signal that the buyers are in control. The institutions see the current price as a good deal, and they'll often step in to defend that line, which makes it act like a moving support level. And you guessed it, when the price is below VWAP, the sellers are in charge, and that line becomes a kind of moving resistance. It's like a scoreboard for who's winning the fight. But hold on. Here's a huge warning, and it's where so many traders get this wrong. They learn about VWAP and they think it's some kind of magic line in the sand. They start buying every time price touches it in an uptrend or shorting every touch in a downtrend. And that, I promise you, is a massive mistake. VWAP by itself is just not enough. Because this is what will happen. In a messy, sideways market with no clear direction, the price is just going to slice back and forth across the VWAP line all day long. If you're blindly trading that line, you are going to get chopped to pieces. It'll just bleed your account dry. Without context, an indicator is just noise. So here's the secret sauce. We need something called confluence. The real explosive power of VWAP is unlocked when it lines up with another important level on your chart, like a major support or resistance zone. This spot, this confluence point, is where the odds stack up in your favor. It's like having a double lock on the door. It's a high probability setup. Okay, let's walk through a full blueprint so you can see exactly how this works. Here is a beautiful long setup. First, you need context, a clear uptrend. Then, we see the price pull back into our confluence area. See that? It's where the rising VWAP meets that horizontal support level. We then get a strong reaction. See those long wicks? That's buyers stepping in. And then, and only then, do we get our confirmation, when price breaks that little downtrend structure. That's the signal the big trend is back on. Let's just break that down into 4 simple, repeatable steps. Number 1, you gotta have context. We need a strong uptrend. 2, be patient. Wait for that pullback to the confluence of VWAP and a support level. 3, watch for the reaction. Those long wicks are your clue that buyers are showing up. And 4, the golden moment. You enter when price breaks the immediate downtrend structure, confirming that the buyers have officially taken back control. And of course, this works just the same on the flip side. Let's look at a short setup. The logic is identical. The context is a clear downtrend. The price then rallies up to a confluence point, where the falling VWAP lines up with a key resistance zone. You see that clear rejection, those long upper wicks, and then the confirmation comes when price breaks below its recent swing low. The sellers are back in town. And again, let's put it into a simple 4-step recipe. 1, the context is a downtrend, making lower highs and lower lows. 2. Wait for the pullback, that rally up to the confluence of VWAP and resistance. 3. Watch for the reaction. Those long upper wicks are yelling at you that sellers are defending their turf. And 4. Get that confirmation. Wait for a break in the upward structure, which proved the pullback is over. Now, here's a little pro tip for you. Don't get caught in the perfection trap. The market is messy. It doesn't care about your perfectly drawn lines. As you can see here, price doesn't always come down and kiss the VWAP line exactly. You need to think of it more as a value area, a zone. If price forms a bullish pattern like a double bottom near the VWAP, that's just as good. You're reading the behavior, not looking for a pixel-perfect touch.
All right, so you've got the core strategy down. Now, let's add one more layer, a layer that really separates the pros from everyone else. We're going to talk about how to get sniper-like precision on your entries by using multiple timeframes. The idea here is actually really simple but so powerful. What looks like a calm, simple pullback on your main chart, say the daily chart, is actually a full-blown trend with its own swings and battles on a lower time frame, like the 1 hour. So by zooming in with our magnifying glass right at our key confluence zone, we can spot the turn way before the rest of the market has a clue. So step 1 happens on your main, higher time frame. You're looking for an early warning sign that momentum might be fading. A great tool for this is the RSI. See here how the price is making a higher high, but the RSI is making a lower high? That's called bearish divergence. It's a huge clue that the upward push is getting tired. Now, this isn't a signal to short right away. No. This is our signal to get ready to zoom in as price starts to pull back toward our VWAP. And step 2 is where we become the sniper. We drop down to a lower time frame, let's say the 1 hour chart. And now we can see the little micro fight that's happening inside that bigger pullback. All we have to do is draw a simple mini trend line connecting the highs of this little corrective move. This line, this is now our trigger. And here it is, the trigger pull. The moment price decisively breaks that little mini trend line on the lower time frame, that is our entry signal. The pullback is officially done. And why is this so powerful? Because you're getting in right as momentum is shifting, way before the higher time frame crowd even gets a confirmation candle. The result? A much tighter stop loss and a way better risk to reward on your trade. Okay, wow, we have covered a ton of ground here. We've gone from understanding the retail trap all the way to building a complete professional-grade trading strategy. So now let's put it all together into one simple, actionable checklist you can use. This right here is what you need to remember. First, identify the overall trend. Is price generally above or below VWAP? Second, and this is crucial, wait for the pullback, don't chase. Third, check for that confluence. Does VWAP line up with a key support or resistance zone? Fourth, confirm the reaction. Are you seeing those wicks or patterns that tell you the big boys are stepping in? And finally, step 5, the optional but powerful step, refine that entry on a lower time frame. And I just want to leave you with this one last thought because it's really the whole philosophy behind this entire strategy. We are not here to predict the future. We are not psychics. We are here to wait for the market to show us its hand at important levels, and then we act on that evidence. Always remember, in trading, confirmation will always beat prediction.